if you drive. But I'm lowering the price.
Yeah.
And I have an open house. I have like 19 agents.
All right.
That's
Can
awesome.
we kind of? Thanks.
Yeah.
You can leave now. I did bring food. I brought food, so. Well, thanks y'all for having me once again. David Brown, Sierra Pacific Mortgage, brought one of our newest colleagues with me, Patrick Mitchell. He just joined us. Brand new in the industry, has a extensive background in different things like ministry, consulting, leadership training, coaching, public speaking, that kind of thing. So now in the mortgage world, it's going to be part of our team here. So I wanted him to be part of this today and let y'all meet him and let him hear some things about mortgage lending and real estate.
Which
So,
I give him a microphone.
yeah, we can hand it
I will
over.
hold the baby.
Yeah. So thank y'all again too, by the way, for all your support with the passing of my mom. That really meant a lot to me. So I really appreciate everyone here. So y'all are awfully kind and caring. So I'm gonna do something a little different than what I've done before. I may fall on my face with this. Callie's experienced this with another group. We did this. But I thought it was a little different. I'm going to hand out some questions that you all kind of gave to me. Some are modified a little bit, some are kind of verbatim. But I'm going to let you guys ask me the question. That way it feels like we have kind of this popcorn Q&A. So while you're eating. So you get that one. Karen, you get one. You want to participate? Ariel, you want one? And I may pass the mic to y'all. You think not you?
We can get the other mic out.
And who didn't get one? Oh, sorry.
Yes.
All right. So I could very easily just ask these questions, just read them off. But I thought it'd be fun if you all asked me. So we'll just go around. So if you have number one, let's start with number one.
You want me to get the other mic out and let them have
Oh
it?
yeah, do that. Yeah.
All right.
So speaking to the mic, say it so where people can hear.
Okay. Hey, mortgage man, I've got a buyer under contract to buy 30 prime time, no chance it floods acres in beautiful Irwin, Tennessee. Can you help him finance it?
No, I can't. But that's a great question. So we do not do land financing, but we know people who do. Y'all know Casey Hodge with Rural First.
Yeah,
She's my
awesome.
go-to. Sometimes clients have their own bank that we'll just refer them to, but land financing is so unique. You can't securitize it because every parcel is different. The acreage is different. You can't really lump it into an investment that sells on the secondary market, at least not in the world that we're in. So we refer folks generally over to Rural First for that. But great question. Thanks for asking. Who's got number two?
Me.
Kelly Weeks.
Yo, mortgage dude, what kind of questions can we agents ask our buyers early on to ensure it's not a waste of your time?
Great question. And if this was your question and you want me to elaborate a little bit on what you're looking for, let me know. That's kind of there's so much, right, to what we do, both in mortgage and real estate. And if I were to flip the role if someone was asking me about real estate questions, most of the time I'm going to try to give them maybe my opinion, but then refer them back to the agent because that's the expert. But I do appreciate maybe trying to kind of, save everyone's time or whatever. Really, I enjoy any kind of question or any kind of opportunity to help and uncover those opportunities myself. If there are some basic questions you can ask a buyer, things like, do you monitor your credit? And most people do. They probably have an app through their credit card company or they're on Credit Karma. More and more people are on Credit Karma. I found. I've never subscribed to it. Do any of y'all do that? No. But it seems like all the time people when I go into this conversation, like, yeah, I want to carry Credit Karma, and here's oh yeah. But you know, kind of getting an understanding of kind of where they fall credit score wise, and if they say, you know, last I checked it was a 450 to 500, then there's some work that we can do perhaps to get them ready. But that person in that range is probably going to have a little while to go before they're ready. And so, but that's still someone I'd like to talk to, at least give them some coaching. What kind of, you know, have you all saved up for a down payment? You know, have you been on your job? How long have you been on your job for? I mean, kind of understanding the stability of the borrower in terms of their employment. Do they have savings that they can put towards down payment or closing costs? You know, general questions like that. But honestly, we relish the opportunity to consult with the client and kind of filter them, because really with us it's not a no. We never turn someone down. It's just a not now, because nothing's permanent. If there's a public record, if there's a judgment, if there's a bankruptcy, foreclosure, short sale, whatever, there's going to be a waiting period. It's going to depend on the loan program. It's going to depend on, you know, the nature of the whatever the thing was. But that time will come, and that will be ready if they do the right things to get ready. Number 3. Did I properly answer that for whoever had that?
Downtown David Brown. We're going to see a lot of first-time home buyers when rental leases come up. How can we prepare them for what qualifies for FHA and what doesn't qualify?
Okay. Yes, I think we're starting to see that now. Maybe with this spring coming in, you know, and the summertime coming, leases renewing. You know, I think the unfortunate thing in our world is a lot of renters we talk to. There's a real sticker shock with payment when it comes to purchase price, interest rates, quoting a payment on houses that they may want to look at, and that's unfortunate, but it's just the reality of this environment. So, you know, as far as preparing them, kind of back to the last question, you know, coaching them on the importance of credit score, making sure all their payments are made on time. Monitoring their credit, making sure that they're not past due, they're not up against their credit limit on their credit cards. That tends to be one thing that really can drag down the credit score, is how much they're utilizing of their available credit. Just try to keep those balances down. Saving as much money as they possibly can. If they got a lease that's going to end in July and they're wanting to buy a house when it ends, then they need to be saving all the money they can. You know, coaching them to be on a budget, because even if we put them in a down payment assistance program like 100% financing, or even if they get their closing costs covered, y'all know it. There's going to be costs involved with buying a house. I mean, you move in, you get to furnish the place. There's going to be something that breaks you didn't think about. So more money on hand is always recommended. And that question was about FHA in particular, which obviously requires a little bit of a down payment. FHA is a little more forgiving on credit score, so we do see a lot of first-time home buyers. That's a good fit for them because we can go down to a 580 on FHA, 3.5% down payment. If they fit within THDA, we can layer on that down payment assistance and give them and loan them the down payment as well. So, but it's always good to have that conversation early on if they're looking to get out of a rental. Number 4, is that next? Yeah.
Mr. Mortgage Maestro, how are rates looking for investment properties and for rental appraisals?
So, good question. The investment market is still pretty good. I mean, from a rate standpoint, I ran a quote this morning with 20-25% down on a single family, in the 7% range, maybe a hair over. You know, for rental property, that's pretty darn good on a 30-year fixed. You're going to pay a little more of a premium on rental property. You know, if you're not going to live in it, then that's going to be a little more in risk to the lender, perceived risk. So a little bit higher rate usually. I think the question, and correct me if I'm wrong, but I think it had to do too with rental. What's the appraisal market climate like with rental rates?
Yeah,
You know,
or if you're projecting a certain type of rental,
Right.
and we're like, yeah, this is projected to be here, are they coming in at that
Right.
price? And I
Right.
know like lower level,
Yeah.
those kind of things to have up front with your investor, that is not
Yeah.
the same as your rental rate on above grade.
Well, that too, yeah, that's a whole other issue. Yeah, so square footage, whether it's above grade or below grade, yeah. So, I think we talked about this last time too. Rental
With
rates
your-
come in low, yeah.
Mhm.
So, let's talk about rental income and how it can be used. So, if someone's buying a rental property, one of the awesome features of rental property financing is the appraiser is going to appraise that property. They're going to do a traditional appraisal. There's going to be an addendum to it. There's going to be a market rent analysis, and they're going to survey the market. And if Danny was here or an appraiser was here, we could tell you more. He could tell you more about how they do that. But they're going to survey the market and come up with a market rent for that property based on their research. Now, a lease in hand can actually trump that. So if you have a lease in hand that's better than what you think would be better, then that can be used. We've had some situations where we got under market rent, a value lower than what we anticipated, and that can kill a deal. If that income is really needed, particularly like on a DSCR, the debt service coverage ratio loans, because it's all about that. I mean, the whole loan is, for the most part, is underwritten based on the income that home is going to, or that property is going to generate. So we had one last month where, and I think I maybe even talked about this before, but it was a big house over in North Carolina, 4 or 5 bedrooms, and the appraiser had it at like a $2,000 monthly rent. And then stood his ground when it was contested, when other comps were presented. So, it's, and location means a lot too. I wasn't real familiar with that area. That had something to do with it maybe. But that can trip up a deal. But oftentimes, the total debt to income ratio of the client is such that it doesn't matter. So if they're buying it, we have other income to rely on. It's not a DSCR loan. It just may not matter. So does that answer that?
Yep.
Okay. Number 5. Was there number 5?
Me.
Make haste. Next year.
Maybe she says. Hey there, David Brown. I hear you're the best in town. You will know this answer. How
That's not how
is
it's
no?
written.
He wrote that just like that. How is student loan debt counted against you when you're applying for a mortgage?
Good question. And there was a memo that put, and I should have gone back and read it again, but there was something came out this week about, or maybe last week, about how there's like 8 million student loan borrowers who are now having to repay, who haven't been, but many of whom it may be a surprise, and they haven't been monitoring it, they haven't been watching their mail, and then all of a sudden they're going to get a 30-day past due or a notice that they're on a loan, which would be terrible. But open your mail. So student loan debt during COVID and kind of the last few years has been deferred, and so a lot of borrowers have not had to be making payments on that. So in that event, we there's a calculation we have to do based on the amount they owe. So depending on the program, so VA, Veterans Loans, makes you, let's see, I think you take 5% of the total amount they owed, divide it by 12, and that's their monthly payment you have to account for, even if it's deferred. FHA, Freddie Mac is 0.5%, so you take 0.5% times their balance, and that's the monthly payment. Fannie Mae's at, I think they may have changed to 0.5% too, but it was 1%. USDA is 0.5%, so it depends on the program. There's different calculations. We are starting to see credit reports come in where there is a payment associated to it, and so we generally would just go by what the credit report is reporting. If it's a 0, that means it's probably being deferred. Now, if it's income-based repayment, there's ways we can sometimes use a lower amount, but it can just depend on the program generally. So does that answer that question?
Now, Matt, did you have a first-time home buyer that was a student or just finished school? Remember that girl that came by and her mom referred us to here?
Yeah.
Did
That
she have
was
student loans?
She did, but her biggest thing is which it's easy for lenders on the medical field, if a student is getting out of school and they've been like in a residency, they're signing something with guaranteed hours and all that fun stuff, then they can just jump right into a loan without having like a ton of work experience behind them, right? And so it's in the
That's
medical
what her
field.
situation was.
Yeah, so she was getting ready to graduate from nursing school, becoming one of those letters, CNA, RNA, whatever, and just came right out. So even though she had student, it's because it just counts against your debts. So yeah, she had student debts, but she also had guaranteed hours and all that fun stuff and decent credit score.
Yeah. So I guess the main question is how's it counted against you? Well, it's factored into your debt to income ratio. So the more student loan debt you have, then maybe the less buying power you have on a home.
What about the work experience? Isn't some of that being substituted if they have?
Education can count as their work history. And FHA a couple years ago came out and said that high school education can count, which is kind of crazy.
What
Now-
about mills?
Moving on.
Okay.
This is a little unrelated, but I'm working with a client right now who was turned down by a big bank because they changed careers, and that is a big time overlay. So if you hear someone who's turned down because they went from being a auto mechanic to whatever else, as long as it's a salary position or a guaranteed hour position, we just need 2 years of history. We don't have to see that it's been the same line of work.
Oh, really?
Yeah.
Yeah, I've seen
You have to be past the probationary period in your.
No.
No, I didn't know.
No. That's a good
Used
question.
to, you did, I mean, I actually had. run
Yeah,
into that.
like if
Yeah.
it's a
Alright,
60
Bill, you're
year-
past,
yeah.
probation period.
Yeah.
20 years ago, that would actually have to be.
Well, yeah.
It was expunged.
Yeah, I've not run into that, but that would make sense, I guess.
Yeah,
Let's make sure you're gonna stick.
you got like a 30-day probation.
Yeah.
So on the professional thing where you got classes,
That's the money.
is there certain professions they do that for, or, if you've had college education, or is that,
They'll usually want the college transcripts.
Will's question was, if you were getting into a profession straight out of college, will your college education or degree count towards almost a work history?
Yes.
it doesn't matter what profession, right?
Well, yes, that's
Does it have to
correct.
be related, or what?
It does not.
Okay.
It is not.
Well, that's really good information for people that are dealing with folks in college, that.
Has anyone here had someone turned down because they were something else in school, and then they got out of school and were in something else, and they said, oh, well, sorry, even though you had some experience, it was in something else, so we can't approve you.
I don't think so.
Just you?
Okay, well, cool, I thought that was a bigger thing.
Yeah.
I've heard that all the
Actually,
time.
I think maybe I have, yeah.
Yeah, right, Paige.
No, actually, one.
Thank you.
You had one where they wouldn't count the school?
Yeah, but
or-
she also had a very odd job, which piled on top of it too, so.
Okay.
She sell only one thing? I'm just kidding.
No.
Only what?
Syria.
Yeah. Numbers.
Well, I had a question.
Yes.
Karen had a
So
question.
talking about students, if somebody's working on like a secondary degree, college degree, like a master's, and they're doing an internship, and the internship was not paid but now they're getting paid a stipend, will the full internship count plus the stipend from a grant, will that be considered income, or
Well, for qualifying or as job history?
just for anything?
Job history, that should be fine.
For job history?
Yes.
Okay.
but if you're leaning on that for qualifying income, this could probably be difficult if it's
Right.
erratic or if there's not a history of it.
But for job history.
For job
sure.
history, it should be fine, yeah.
Okay.
Karen's question was on secondary, continued education, such as going for a master's degree. If she has an internship and it's paid later, will that account for anything? David says yes, counts for the background, but not necessarily additional income comes into play.
Boom, nailed
Out
it.
of here.
You should be a stenographer or something.
Thank you.
Yeah.
Now, here's number 6.
Number
Bam!
6.
Maestro Brown, how is a credit score taken and used by mortgage companies?
So, good question. Thanks for asking. So when we do a credit pool, when we do a full credit pool, which is a hard inquiry, we're doing a tri-merge credit pool from Equifax, TransUnion, and Experian. We take the middle score of those 3 scores. We have to have at least one score. But most of the time we get all 3 scores in. So we use the middle score. And I think there was more to that question. It's going to be a different score than what someone sees, and I know we've probably talked about this. It's going to be different than what you see on your credit card app or your Credit Karma.
Mm-hmm.
Different algorithm for mortgage, just like if you go to the car dealer, they run your credit, you're going to get a different score there. Different score credit cards. Now, if you're going to ask me how all the sausage is made, I don't know. I mean, it's pretty complicated. There's just different algorithms and different weightings, and TransUnion's got a different formula than Equifax, different than Experian, and so and I think the reason why we use all 3 is it kind of you get a good barometer of where the credit is based on all 3 models. But that's something that people are often confused about. Why is my credit card showing that I've got a 630 and you're saying I have a 590? It's like, well, it's different calculation, different type of credit you're applying. So that's a very routine conversation we have.
So you take the middle, not the average.
Take the middle, that's exactly right. We don't average them, we take the middle. Now, there are some programs, I think more in the non-QM space, the non-qualified mortgage space, where you can do that. You can take an average. I haven't really run into that much, but there's some different things there, little nuances, but generally speaking, middle score.
Okay.
If it's a couple and one has a better
Yes.
score than the other, what happens?
Then we have to use the lower middle score of the
You
2
have to
bars.
use
Mhm. Yeah. So there's sometimes where we'll run into that and not both borrowers aren't needed to be on the application to qualify. So we'll just remove one borrower with the lower score, keep the other one as long as they can still support the loan, and that helps their interest rate most of the time. Yeah, unfortunately. Now the tough situation with that is borrower A has an 800 score but makes no money. Borrower B has a 500 score but makes all the money. It's like, well, we're gonna have to get that score up or that income up.
Okay, because they're on opposite.
Because if we can't use your score, we can't use your income. You
Mhm.
can't be on the loan.
So for people who don't know, what's a non-QM?
Non-QM is a non-qualified mortgage. So it would be a mortgage that's not qualified to be sold to Fannie Mae or Freddie Mac or per their guidelines. And so there's going to be other investors who purchase that loan, and it's going to be a more risky loan just because there's certain guidelines they can't meet, so the bar can't meet. So maybe it's a DSCR loan where we're not using their tax returns. We're just using the property. Well, it's more risk, or we're just using bank statement deposits for their income. More risk. So a little bit higher interest rate. Yeah.
So what makes a secondary mortgage want to purchase a mortgage? Like, what's the
The investor, what makes the
like
investor?
what's the what rate? Like what does the investor gain?
Sorry, Dustin, I don't see the.
Yeah, this is
This is not part of the program.
now say like or like the non-QM mortgages.
Yeah.
There's an investor out there.
Yeah.
What's like what is there like? What do they gain by taking on this mortgage by purchasing the mortgage?
An income stream. when that payment's made, if they're getting a portion of that. And so there's a block of loans that all fit that guideline, and it's being packaged and sold as a security. So to the borrower, it's a loan. To the investor, it's an asset, it's an investment. And that's one thing that kept our mortgage rates down so low during COVID in the last few years was all these mortgage-backed securities were being purchased billions of dollars every month by the federal government. And the volume of loans that were being bought compressed that rate down, and kept rates low artificially artificially low for an extended period of time. Whereas if they didn't do that, rates would have gone up, and then we wouldn't have seen the inflation that we saw, the house prices, jump up like we've seen. So, but to the borrower, it's a loan. To the investor, it's an investment. That's why they call it second. It's sold on the secondary market.
So I guess my question would be, do you sell it to them at a discounted price? Or are they buying it like lumped into other mortgages, or are you buying that one mortgage in particular, the investor? So, or are they buying it for what you have in it, or for what the mortgagor has in it?
Well, they're going to group, when they package the loans, they're going to package loans that all kind of fit the same profile, so risk profile. And they may pay, as a gross margin, they may pay like 5 or 6% of that, and then it filters on down through the company, and then as those payments are being made, they're receiving the interest income over the duration of those loans. And the average duration for a mortgage has traditionally been 7 to 10 years. Now it's shorter because people they're expected to refinance, and so it makes loans more expensive and all this. But I don't know if that answers your question.
Yeah, kind of.
Yeah.
So it's, how I understood it as the underwriters are prepping it, they're essentially making sure everything looks good, but it's also marketable in the secondary market.
Exactly. That's why loans have to conform. You've heard conforming loans. It's got to conform to Fannie's requirements or Freddie's or.
So when you're marketing that loan, hey, this person has this credit score, this is their background, this is what kind of interest it's yielding, this is the note it's on, and then that's nice, rather than hey, here's a 582,
Yeah, well, that goes in the 580 bucket.
Yeah.
The other 580s. Yeah.
Yeah, and people are like, I don't know if I want to buy it.
Or it's a range of whatever. Honestly, I don't know how they're all packaged, but similar risk profiles will be grouped. And,
Okay.
Yeah.
The higher the risk, the higher interest rate he's gonna get
Yeah.
a return on his
Yeah.
money. That's the
Yeah.
bottom line.
Yeah, and the more likelihood of default.
Yeah.
That's probably why it's more expensive for people to buy closing costs, things like that, for a lower credit score.
Mm-hmm. Yep, there's a premium there. There's a loan level price adjustment for lower credit score, higher LTV.
Okay.
Property type. Manufactured home is going to be more than a single family house, single house.
Your company sells all the, you don't keep any mortgages.
We retain servicing of most of our loans, but we do sell some. Just depends on the market. There's companies out there right now paying insane premiums for loans because they know the refi boom is coming, and so it's a business decision. We can make it a lot more on a loan by selling it and then reinvest that into better pricing, maybe better rates, more marketing or whatever. But you just look at the market, and there's companies like you've probably heard of some of these servicers like PennyMac and Mr. Cooper and Freedom Mortgage. These companies are like just moving all their chips to the center of the table. The rates are going to come down, and then they get our client and they bombard them with solicitations. So
I just worked with Mr. Cooper.
Yeah.
No
Thank you.
communication the
Well,
whole entire
yeah.
transaction. I was like,
Yeah, they're refi shops. I mean, that's all they are. Their staff is probably not the most trained, probably not the most tenured, but they're on the phones all day and generating leads or generating refinances. Some people that works for them. Some people they value more of a personal relationship. So, number, is that good on that? Number 7, is that right? Yeah, 7.
That's it.
oracle of lending. How can we coach our clients to buy before they sell? Home sale contingencies keep tripping us up.
I can't remember who asked that question, but was that you, Ron? So home sale contingencies are a real thing. I know that. Would y'all say we're still in a seller's market? If it's priced right, if it's got curb appeal, if it's moving ready, it's a seller's market, right?
Yeah, it's just we don't have a lot of inventory, so it's really like if it is an awesome home,
Yeah.
price where it needs to be, it's still multiple offers.
Yeah.
Attack.
Yeah. So
If it's, overpriced, and then we can do some cool stuff for your buyer.
right. You meant like the 2-1 buy down maybe, or
Yeah, or I've come in, I've got like a good chunk of them, like 30 or 40 under asking.
Right.
And sometimes that's blended with, okay, give me 20,000 in closing costs because we want to buy down the rate, or we want to, do whatever we want to do.
Yeah, I had a client just go to contract yesterday who they had a price reduction, which was still overpriced, and they went in with their offer and they accepted it like it was still 30 or 40 below the new price. And that person went in with a non-contingent offer, I think. No, they didn't. They were contingent. They did get accepted, but they've got a really marketable house they're selling. They should go looking good. So, everyone's situation is different. Their buying capacity is different based on their income, their wherewithal to put money down before they sell. Some people can afford to swing 2 mortgage payments and everything else. Some people can't. We've done things like home equity loans, home equity lines of credit, home equity loans to give them the down payment they need. We just closed one last month, or maybe earlier this month, where we did a home equity loan for them on their condo that they were going to keep turn into a rental. It was like I think an $80,000 loan. They took 30 to pay off some high interest, high payment consumer debt, and then used the 50 to use as their down payment. And on conventional financing, you can put as little as 5% down if you're not a first time home buyer. So, and they can swing both payments. You know what? They're going to take their condo and they're going to rent it. So you can use departing residence rental income, and things have loosened up on that. So if you're moving out of your home, but you need some rental income to help offset the mortgage for the existing mortgage or the new house, we can work with that. But you have to have a tenant in place with a lease, at least a 12-month lease, first month rent, and a security deposit. The deposit doesn't have to match the first month rent, so it could be $100 or whatever. But that's one way to kind of help offset that. But that has nothing to do with contingency. So, but if you are keeping your home, there's a ton of equity out there. We do see a lot of home equity financing. So we have some products that make sense for them. We can do that. Otherwise, we might steer them to their local bank or credit union where they can do a HELOC or something. But if they're going to do that, they shouldn't put their home on the market for sale. And they should also probably do that months in advance, because some lenders don't want to do an equity loan.
Oh, no.
I know home equity is a very sensitive subject, I guess.
You gotta bring it up, don't you? It's really hard. We know what you want.
Teamwork is stressful.
There's a lot of pressure on there as it is. Match my every day.
But it's kind of like a bridge loan. We kind of treat home equity as kind of like bridge financing. But you want to plan that out months in advance. You don't want to. I had someone just the other day who was like, okay, I want to get a HELOC on my existing house so that I can then buy a rental property. And it's like, well, they had already gone under contract and about to close on the new house. And he's like, we should have done that months ago. So does that answer the question decently enough?
On that same topic, if you're using, so say you got them to a local bank that can do a HELOC, how does that process work? Do they already have to have the loan through them, or are they gonna have to
Like if they already have a mortgage on their house?
right?
Yeah, some banks are very particular about not wanting to be in second lien position behind someone else. Most are fine with it, but they'll have loan to value ratio requirements where they don't want to be made over like 80%, or some banks might go up to like 89.9 or whatever the top percentage is without being a reg violation. I think Eastman at one time was doing like 100% HELOCs. I don't know they are now, but generally you'll see banks go up to 80 to 90%. They'll want either a full appraisal or a drive-by or a desktop or some kind of way to substantiate the value. One of the credit unions in town used to use Zillow, the Zestimate. They just print off the Zestimate, put it in the file, and that's the value, which is
I vote for that.
yeah. That same credit union had a really unique home equity product too that no longer exists. But anyway, that's one
Yeah,
of
that
You're like,
sounds
that
like
same bank no longer exists.
those. Right.
Let's get rid of the appraisal business and.
That may happen one day. I think we might be heading that direction. Appraisals.
I'm afraid Zillow may be doing the loans too, though, that's the problem.
Yeah, well, that's true. They're in the business.
They're in the
Yeah,
business.
yeah. I don't know if Realtor.com is. I don't think they are.
I don't think so.
Not yet.
But the information's getting better all the time. I mean, technology's getting better.
Don't fall into it, dude. Don't
No.
Don't push it.
No, we're gonna resist.
We will resist.
AI is taking over. It's gonna be robots. So anyway, did we cover that?
Yeah.
Okay. Number 8, is that where we're at?
Oh, that's me.
Where's the mic?
Oh,
Okay, you have the mic.
Okay. Hey, David Brown. How can we best prepare clients for scenarios of what might cause their loan to fall through and ensure that they are set up for success?
Great question. Thank you, sir. So what could derail a loan? Well, there's like a million things. I mean, and we try to do our best to have conversations with clients early on about some obvious things to not do, like go out and finance anything until we're done with this process. Don't quit your job. Be very forthcoming. Like we found out a couple days ago that a client just took a new job and they're closing next week.
Oh, no.
And and I probably didn't explicitly say don't quit your job and start. Now we can still get the deal done, but it's just another wrinkle. And now because of documentation, we may have to extend the closing, which doesn't.
Common sense ain't common.
But there's a million things like that can happen, and so.
And I've heard people like to go buy a new car the weekend before closing.
Yeah, well, that's
Happened to me.
in technology has gotten so good where now we get the underwriters get notified through different reporting if you've had your credit run or if you've opened a new account. So you get, the best advice y'all can give clients is like be as forthcoming and honest and open as you possibly can be, because it will get found out at some point, more than likely. The HELOC thing we hear about now, people didn't have the assets that they said they did, and so they're trying to they go to try to open a HELOC right before closing, and that gets found, and then that payment's got to be added to their debt to income ratio, and sometimes that kicks it over. So there's something we were talking about this morning today where a client did something, or more and more information is coming out that's just going to make it so much harder to get their loan done. This is like, man, if you could just be transparent from the beginning, it would be so much easier. We underwriters are going to look at every bank statement. They're going to look at every transaction. We had one where there was any kind of recurring payments that are on a bank statement, and underwriters are going to say, hey, what's this? This is not only is this a loan or whatever, and then we have to source it, and child support payments, alimony, stuff like that. So it's just better for people to be transparent. So I don't know if I've completely answered that the best I can, but best prepare clients for what might cause their loan to fall through. There's some things outside the borrower's control, things with the property, maybe through the appraisal, title issues. We have one right now, we're trying to do a 203K loan on a house where the seller is deceased. And there's a 12-month, the will hasn't been probated, and so they have to wait 12 months to make sure there's no claims against the estate. It's little things like that. So, and some of that stuff doesn't come to light till you're kind of in the deal. But from a lending standpoint, the more open and honest they could be at time of application, the better.
From a lending standpoint about appraisals, from the lender's standpoint, do you all, what's your take on like the appraisal didn't come in good? And they want to have somebody else do it, if the client's willing to cover it, get another appraisal, what's your all thoughts on that?
So Karen's question is, if an appraisal comes in that's not satisfactory to the client, can they have another appraisal done? The answer is no. That's a hard no.
Yeah.
Now, are there legitimate reasons why it didn't come in where everyone thought it should? We can do what's called a request for reconsideration of value, where we would then ask the agent to provide some better comps than what the appraiser used, and then make a case for why those comps should have been used rather than the ones they used. And we've seen, sometimes we'll see appraisers adjust a little bit, but they're proud of their work most of the time, and they usually will stand by what they've done.
Turn the camera off and now tell us what you're doing.
Yeah.
That was really clever. I like that.
I mean, we honestly, we haven't seen many appraisals come in low, thankfully.
Well, that's good.
Lately, I mean, it hasn't happened a lot. Have y'all seen that much?
Oh, we're so good at figuring out what they're worth.
Right on the nose.
We're right on the nose.
Yeah. Well, isn't that funny? That happens a lot of times. That appraisal comes in.
I can't figure it out.
Imagine that.
I'm good at math, it's not working for me.
Right.
Plus, I know this crew around here, there's certain people, they don't want to do their appraisal.
Yeah.
Karen, I'm
That's
gonna tell you,
usually
the answer to your question is that appraiser hates to adjust anything, and he's got more explanation for the reason he can't use your comp, and you'll never understand them, no matter how many times he tells you.
Yeah. He's not getting paid anymore too.
No.
If I spend more time on it. So.
Yeah, he's not gonna do it for the most part.
Yeah. But no, thankfully, I think we haven't had that be an issue recently, and hopefully that'll continue. So. That's all the fun I had planned. Someone asked about success stories. We're closing a couple THDA loans the next week or so. One's on a double wide, one's on a house. I'm closing a choice renovation. Y'all heard of 203K?
Yeah.
203K FHA rehab loan. We're doing one of those right now, and then I have my first conventional rehab loan, which is a 5% down payment on the total cost. So purchase price plus reno, they put 5% down. It's a conventional loan, not quite as intrusive as FHA. So that's been pretty easy actually. It's right over here on 8th Avenue. So DSCR, doing a DSCR loan right now.
That's one of those like
Debt service coverage ratio, just based on the rent of the property.
with no tax records.
Correct. Yep. Just have to have credit score, market rent on the home. This is actually a cash out refi, so, and then hopefully an appraisal that gets what she needs. So those are some things we're doing. Thank y'all for having us.
Thank you.
And sums it up.
You want your questions back?
No. You can please discard them in the shredder.
Hey, can everybody line up in front of my desk for a picture?
Oh, no.
Y'all know the drill, no complaining.
You want me to hit finish?
Yes.
I will take the picture, because I